Alright, let's be honest, we all want to make money, right? But just saying, I want to be rich, isn't a goal. It's a wish. To turn that wish into a reality, we need to get specific. It's time for some soul searching. This is about figuring out what you want to achieve with your investments. Defining objectives. Why are you investing? What are you hoping to achieve? This is where we get down to brass tacks. Are you saving for a down payment on a house? Maybe you're dreaming of that cozy cottage by the lake. Or perhaps you're planning for a comfortable retirement, filled with travel and adventures. Maybe you want to set up a fund for your kids' education, so they don't have to start their adult lives saddled with debt. Whatever it is, you need to define it. Write it down. Make it real. I like to use the SMART goal framework. You want your goals to be specific, measurable, achievable, relevant, and time-bound. So, instead of saying, I want to save for retirement, you might say, I want to have $1 million saved in my RRSP by the age of 65. See the difference? That's a SMART goal. Risk assessment. Okay, here comes the gut check. How much risk are you willing to take on? This is crucial, and it's something a lot of people get wrong. They chase those high returns without considering the potential downsides. Investing is not gambling. It's about making calculated decisions based on your risk tolerance. Think of it like this. Are you the type of person who loves roller coasters, or do you prefer the gentle sway of a carousel? Some people can handle the ups and downs of the stock market. They're okay with seeing their portfolio value fluctuate, knowing that it's a long-term game. Others get queasy at the slightest dip. They'd rather have slow and steady growth, even if it means potentially lower returns. There's no right or wrong answer here. It's all about what you're comfortable with. Be honest with yourself, because if you take on too much risk, you might panic and sell at the worst possible time, locking in losses. Time horizon. How long do you plan to invest? This is another biggie. Are you investing for the short term, say, less than 5 years? Or are you in it for the long haul, like 10, 20, or even 30 years? Your time horizon will significantly impact your investment choices. If you're saving for a down payment that you'll need in 2 years, you'll want to stick with relatively safe investments, like a high-interest savings account or a GIC. You don't want to risk losing your principal in the stock market when you need the money soon. But if you're saving for retirement and you're still in your 30s or 40s, you can afford to take on more risk. You have time to ride out the market's ups and downs. Historically, the stock market has always recovered from downturns and delivered positive returns over the long term. Investment style. Are you a hands-on investor, or do you prefer a more passive approach? Do you enjoy researching individual stocks, poring over financial statements, and staying glued to market news? Or does that sound like a total snooze fest? If you're the former, you might enjoy actively managing your portfolio, picking your own stocks and making your own trades. But if you're the latter, you might be better off with a passive approach, such as investing in index funds or ETFs. These funds simply track a particular market index, like the S&P/TSX Composite Index. They require less work on your part and typically have lower fees than actively managed funds. There are also different investment styles to consider. Value investors, for instance, look for undervalued companies that they believe are trading below their intrinsic worth. Growth investors, on the other hand, seek out companies with high growth potential, even if they're currently trading at a premium. Dividend investors focus on companies that pay out regular dividends, providing a steady stream of income. Figuring out your investment goals and risk tolerance is like creating your own personal investing roadmap. It's about understanding where you want to go and how you want to get there. Once you have these things figured out, choosing the right investments becomes a whole lot easier. Don't rush this process. Take your time, be honest with yourself, and don't be afraid to adjust your plan as your circumstances change. In the next section, we will discuss choosing the right investment accounts.